Global markets are witnessing an unprecedented shock as silver skyrockets 7.5% in a single day, reflecting a rapidly intensifying flight from the US dollar. This extraordinary surge is not a fleeting speculative move. It is the tangible consequence of a coordinated shift by central banks, sovereign wealth funds, and institutional investors seeking refuge from declining confidence in fiat currencies. As traditional safe havens strain under unprecedented demand, the metals market has become a real-time indicator of systemic stress, with ripple effects spreading across equities, bonds, and foreign exchange. Industrial users face mounting supply pressures, while the broader financial system grapples with volatility and liquidity fragmentation. The speed and magnitude of silver's rise signal a structural inflection point in global finance, where traditional dollar dominance is being challenged, and markets are forced to recalibrate risk, valuation, and strategic allocations in real time. The unprecedented surge of silver, marked by a 7.5% daily increase, represents far more than a temporary market anomaly or speculative spike. It is a structural signal of a profound and accelerating process of dedollarization that is reshaping the foundations of global finance. Historically, the US dollar has functioned as the unchallenged anchor of international reserves, trade settlements, and cross-border liquidity management, providing a central point of reference for pricing commodities, denominating sovereign debt, and orchestrating capital flows. For decades, the dollar's dominance relied not merely on the size and liquidity of US financial markets, but on the implicit assurance that its value was backed by the geopolitical and economic preeminence of the United States. This implicit trust has allowed central banks, institutional investors, and multinational corporations to anchor their strategic planning and reserve management around the dollar. The current silver surge, however, is a tangible manifestation of that trust being actively questioned, reflecting a reallocation of capital toward tangible stores of value that operate outside the conventional dollar system. The magnitude of silver's acceleration is directly tied to the growing dissatisfaction with dollar-denominated assets as a reliable hedge against currency depreciation and macroeconomic instability. Central banks, particularly in emerging markets and within the BRICS coalition, are increasingly diversifying their reserves into physical silver and other tangible assets as a defensive measure. This trend is underpinned by multiple converging pressures. The expansion of US fiscal deficits and elevated debt burden, the ongoing use of the dollar as a tool of geopolitical leverage, and the real-time visibility of financial sanctions. For countries seeking autonomy from the reach of US policy instruments, silver and precious metals more broadly offers an asset that is universally recognized, physically deliverable, and insulated from direct policy manipulation. In essence, silver is transitioning from a commodity that historically straddled industrial and monetary roles into a primary instrument of currency risk management and sovereign financial strategy. The broader implications of this de-dollarization trend are multifaceted and profound. On a macroeconomic level, the rapid accumulation of silver by central banks and sovereign wealth funds undermines the traditional role of the dollar as the ultimate liquid reserve. As these institutions shift allocation strategies, the velocity of cross-border capital flows is being altered, disrupting conventional correlations between equities, fixed income, and foreign exchange instruments. Traditional hedging models that rely on the stability of the dollar as a baseline are becoming increasingly inadequate, exposing portfolio managers and financial institutions to unforeseen volatility. This creates a feedback loop. As confidence in fiat stability declines, additional capital moves into tangible stores like silver, which in turn exacerbates price pressures, liquidity constraints, and market volatility across multiple asset classes. The silver market, once a relatively small component of the global financial system, is now a systemic signal that cross-asset risk and correlation dynamics are undergoing a structural transformation. The geopolitical dimension of silver's ascent further underscores its significance in the context of de-dollarization. BRICS nations, in particular, have actively pursued mechanisms to reduce exposure to US-centric financial instruments. Initiatives such as local currency trade settlements, bilateral currency swap agreements, and commodity pricing outside the dollar framework complement the accumulation of precious metals. Silver, with its unique combination of industrial utility and monetary characteristics, functions as both a strategic reserve asset and a hedge against geopolitical uncertainty. By incorporating silver into reserve portfolios, these nations are effectively constructing a parallel financial architecture that can operate independently of dollar-dominated networks. This parallelization reduces the leverage that the United States has historically exerted through its control over dollar liquidity and financial market infrastructure, introducing new degrees of autonomy and risk into the global financial system. The industrial and strategic characteristics of silver amplify the systemic impact of this de-dollarization. Unlike gold, which is primarily a monetary metal, silver straddles both industrial and monetary domains, being essential in solar technology, batteries, semiconductors, and advanced electronics. This dual role creates a natural floor for demand. Even as prices surge due to reserve accumulation, industrial consumption remains largely non-discretionary. The combination of strategic reserve accumulation and industrial necessity has created acute supply pressure, elevating sensitivity to incremental purchases and amplifying volatility. Each additional ton of silver purchased by a central bank or sovereign fund exerts a disproportionate influence on price formation, operational liquidity, and derivative pricing. This convergence of monetary and industrial demand illustrates that silver is not merely responding to market sentiment, it is reflecting deep structural shifts in the global financial ecosystem. Financial market participants are increasingly recognizing that silver's role as a strategic asset has direct implications for portfolio construction, risk management, and capital allocation. The rapid reallocation of capital from traditional fiat-denominated assets, dollar bonds, U.S. equities, and dollar-backed derivatives, into silver disrupts long-standing correlations that underlie asset pricing models. The resultant fragmentation introduces elevated systemic risk. Liquidity in bullion-backed ETFs, futures markets, and derivatives is constrained, price discovery is more volatile, and operational mechanisms are stressed. Industrial users and technology manufacturers, reliant on predictable access to silver for production, are also exposed to rising input costs and potential supply disruptions. The feedback between strategic accumulation, industrial necessity, and market liquidity reinforces the role of silver not only as a hedging instrument, but also as a barometer of systemic fragility in the global economy. Silver's current trajectory underscores a structural evolution in international finance. Dedollarization is no longer a peripheral consideration limited to niche emerging market strategies. It is being operationalized through tangible asset accumulation and restructured reserve management. This evolution challenges the long-standing assumption that the dollar is the default anchor of global financial stability. As central banks and sovereign wealth funds integrate silver into their reserve strategies, market participants are compelled to reconsider risk, liquidity, and correlation frameworks, accounting for a more multipolar and tangible-centric reserve landscape. The implications extend beyond precious metals markets, affecting cross-border lending, trade financing, interest rate spreads, and the pricing of commodities denominated in alternative currencies. In conclusion, silver's meteoric surge represents the crystallization of accelerating global dedollarization. It signals a paradigm shift in reserve management, where tangible assets like silver function as both hedges and strategic instruments, insulating nations from potential currency depreciation, geopolitical pressures, and systemic shocks. This movement is fragmenting traditional asset correlations, elevating market volatility, and redefining liquidity dynamics, with far-reaching consequences for financial stability, industrial production, and geopolitical leverage. Investors, central banks, and policymakers must recognize that silver is no longer a marginal hedge. It is a central indicator of structural realignment in the international monetary system, reflecting a deep-seated reordering of financial trust, capital flows, and reserve strategy on a global scale. The ongoing acceleration of dedollarization, reflected in silver's rapid ascent, is likely to continue reshaping market structures and influencing the strategic calculus of nations. The interplay of industrial demand, strategic reserve accumulation, and declining dollar confidence establishes silver as both a critical hedge and a systemic stress indicator. Its price movements now signal more than market sentiment. They reflect the evolving architecture of global finance, the redistribution of reserve power, and the rising significance of tangible assets in mitigating the vulnerabilities inherent in a dollar-centric system. This transformation has profound and enduring implications for capital allocation, monetary policy, and geopolitical leverage, establishing silver as a defining element of 21st-century financial strategy and systemic resilience. This analysis, based on observed flows, reserve strategies, and geopolitical context, demonstrates that silver's surge is not an isolated market phenomenon but a structural recalibration of international finance. The metal now serves as a tangible expression of dedollarization, revealing both the vulnerabilities of fiat-centric systems and the emerging multipolar architecture of global capital. The 7.5% daily increase is a quantitative manifestation of a broader strategic realignment, confirming that the era of unquestioned dollar dominance is confronting unprecedented and accelerating challenges, with silver as a central instrument and indicator in this transition. The sustained strategic accumulation of silver, coupled with its industrial indispensability and the coordinated actions of BRICS and other emerging economies, ensures that its role will remain pivotal in global financial recalibrations. Central banks, sovereign funds, and institutional investors are actively integrating silver into long-term reserve frameworks, creating a structurally constrained market with heightened sensitivity to macroeconomic, geopolitical, and policy developments. The result is an elevated systemic profile for silver, wherein price movements are amplified by liquidity limitations, concentrated demand, and strategic significance. This establishes the metal not only as a financial hedge, but as a barometer for ongoing structural shifts in the global economic order, indicating a period of profound adjustment in both market mechanics and geopolitical leverage. The implications of this realignment extend beyond the silver market itself. As capital reallocates to accommodate dedollarization, traditional financial instruments and market structures face unprecedented stress. Hedging models predicated on stable correlations are increasingly unreliable, while derivatives, ETFs, and futures markets linked to dollar-denominated assets experience amplified volatility. Industrial supply chains dependent on silver are exposed to cost pressures and procurement uncertainties, which may cascade into broader technological and manufacturing sectors. The intersection of strategic reserve behavior, industrial demand, and declining fiat confidence establishes a feedback loop, reinforcing volatility and systemic risk while simultaneously enhancing silver's role as a critical indicator of financial stress and monetary realignment. In sum, the meteoric rise of silver is not a transient market event, but a tangible reflection of accelerating dedollarization, structural reserve diversification, and shifting geopolitical influence. It highlights the erosion of unchallenged dollar dominance, the strategic recalibration of central bank portfolios, and the emergence of tangible assets as central instruments of systemic resilience. Markets, policymakers, and investors must interpret silver's ascent as a fundamental signal. The architecture of international finance is evolving, liquidity dynamics are fragmenting, and traditional assumptions regarding fiat currency stability are increasingly tenuous. Silver has become both a defensive hedge and a real-time measure of structural change, embodying the profound reordering of risk, capital flows, and financial authority on a global scale. This chapter concludes with the recognition that silver's role in the 21st century is fundamentally different from historical precedent. It operates as a dual instrument, simultaneously anchoring reserve portfolios and serving as a systemic stress gauge, reflecting the intersection of monetary, industrial, and geopolitical imperatives. The current surge, while unprecedented in magnitude, is emblematic of long-term strategic shifts, highlighting the profound implications of dedollarization for market structure, liquidity, and cross-asset stability. The continued monitoring of silver flows, price dynamics, and accumulation patterns by central banks and sovereign entities will be essential for understanding the evolving contours of global financial resilience, systemic risk, and the redistribution of monetary influence. The current dynamics of silver markets reflect a convergence of industrial necessity and strategic accumulation that has pushed this metal into a position of systemic significance, far beyond its traditional role as a minor monetary or speculative asset. Silver is uniquely situated at the intersection of industrial functionality and financial hedging, making it particularly sensitive to fluctuations in both physical supply and investor behavior. Unlike gold, which is primarily monetary, silver is extensively utilized in modern technology, renewable energy solutions, and critical industrial processes, creating a baseline of non-discretionary consumption that constrains the elasticity of supply-demand equilibrium. The surge in prices, exacerbated by C-accelerated institutional accumulation and central bank interest, is therefore not merely a reflection of speculative exuberance. It is a structural phenomenon rooted in tangible economic realities. This structural scarcity, combined with heightened strategic demand, generates pronounced volatility and systemic stress in global markets, with implications that extend from commodity trading floors to the very architecture of technological supply chains and industrial production globally. The industrial profile of silver is a critical component in understanding the scope of its scarcity. Photovoltaic technology relies heavily on silver for conductive pathways in solar panels, while batteries, particularly those in emerging electric vehicle and renewable energy storage systems, require precise quantities for optimal efficiency and longevity. Semiconductors and printed circuit boards depend on silver's high electrical conductivity, and medical devices, including diagnostic equipment and antimicrobial applications, use silver for its chemical properties. Unlike discretionary commodities whose usage can be postponed or substituted in times of price stress, these industrial applications are largely mandatory, dictated by technological specifications and regulatory requirements. As demand from these sectors continues to expand in parallel with global decarbonization initiatives and technological adoption, the baseline consumption of silver remains structurally rigid. limiting the capacity of markets to absorb incremental speculative or strategic purchases without creating significant price dislocations. Compounding these industrial pressures is the constrained nature of silver supply. Mining production has remained relatively static over the past decade, with exploration and capital investment lagging behind the accelerated demand from both technological and financial channels. Newly developed mines cannot be brought online rapidly due to geological, environmental, and regulatory constraints, meaning the global inventory of extractable silver is effectively finite in the near term. This tight supply profile creates a situation in which incremental demand, whether from industrial procurement or strategic accumulation by sovereign wealth funds, central banks, or institutional investors, has an outsized impact on pricing. Each ton of silver removed from the market for strategic purposes reduces availability for industrial consumers, amplifying cost pressures and heightening sensitivity to price movements, particularly in futures markets and over-the-counter trading platforms. This structural limitation introduces a feedback loop wherein scarcity-induced price increases drive further accumulation, exacerbating volatility and creating systemic implications for broader commodity and financial markets. Strategic accumulation of silver by financial institutions and central banks intensifies the scarcity dynamic, overlaying a monetary dimension on top of industrial necessity. In emerging markets and within BRICS nations, silver is increasingly being treated as a hedge against currency depreciation, inflationary pressures, and geopolitical risk. Unlike speculative retail flows, these strategic purchases are deliberate, long-term, and often involve physical delivery, permanently removing silver from the supply pool accessible to industrial and technological users. The interaction of this demand with the inflexible industrial baseline creates an environment in which price discovery becomes highly sensitive to incremental shifts in both supply and demand. The result is a market that reacts with pronounced amplitude to macroeconomic announcements, geopolitical developments, and policy interventions, generating volatility that extends far beyond the silver market itself into equities, commodities, and currency markets that are functionally linked to industrial production and technological output. The amplification of market volatility is further enhanced by the feedback mechanisms inherent in financial and industrial interdependencies. Rising silver prices directly affect the cost structures of manufacturers in solar, battery, semiconductor, and medical technology sectors, prompting adjustments in production budgets, pricing strategies, and investment in alternative technologies or substitutes where feasible. Such cost shocks can ripple through supply chains, impacting the affordability and availability of high-tech products globally, from consumer electronics to renewable energy infrastructure. Simultaneously, elevated prices attract additional speculative interest, including derivatives and futures positions, which can magnify day-to-day price swings. This cyclical reinforcement of scarcity, cost pressures, and speculative momentum creates a complex and self-reinforcing volatility environment, in which silver functions as both a critical input for industrial processes and a highly reactive financial instrument. Geopolitical factors also interact with the industrial and strategic demand profile of silver to heighten systemic risk. Many emerging market nations and resource-rich economies are leveraging silver accumulation as part of broader dedollarization strategies, using the metal to hedge against exposure to the US dollar and potential sanctions or policy interventions. This coordinated accumulation introduces cross-border tensions in the physical market, as traditional trade flows are disrupted and inventories become increasingly concentrated in strategic hands. Supply chains for high-tech industries, which often depend on internationally sourced silver, face uncertainty not only from market pricing but also from potential geopolitical restrictions, export controls, or logistical bottlenecks. The combination of structural industrial demand, strategic accumulation, and geopolitical uncertainty produces a market environment that is uniquely sensitive to both policy decisions and macroeconomic shocks, making silver a critical bellwether of systemic financial and industrial stress. The dual role of silver as both an industrial input and a strategic reserve asset has profound implications for risk management, portfolio allocation, and market operations. For financial institutions and investors, traditional hedging models that rely on predictable correlations between equities, bonds, and commodities are increasingly unreliable. The interaction of strategic accumulation with non-discretionary industrial consumption creates abrupt price shocks that propagate through derivative contracts, ETFs, and futures positions, straining liquidity and operational capabilities. Industrial users must navigate not only higher input costs but also the unpredictability of supply timing, potentially leading to production delays or shifts in global competitive dynamics. In this environment, silver price movements are no longer simply reflective of market sentiment. They are emergent properties of systemic structural forces that integrate industrial, financial, and geopolitical variables simultaneously. This intersection of factors ensures that silver's price trajectory is both a signal and a driver of broader market dynamics. As strategic accumulation continues alongside ongoing industrial expansion, each incremental movement in price reverberates across multiple layers of the global economy. Technological sectors experience cost pressures, capital markets experience volatility, and macroeconomic indicators such as trade balances and reserve compositions adjust in response. The interdependency of these variables underscores silver's elevated systemic importance, positioning it as a critical asset for monitoring the health of industrial supply chains, financial stability, and geopolitical alignment. It has transitioned from a commodity with primarily niche applications into a central indicator of both industrial and financial systemic stress. In conclusion, the compounded impact of industrial and technological demand on silver scarcity cannot be overstated. The convergence of non-discretionary industrial use, constrained supply, and strategic accumulation by financial institutions and sovereign actors has created a market environment of heightened sensitivity, elevated volatility, and systemic significance. Each incremental transaction, whether industrial or strategic, has outsized effects on price formation, liquidity, and supply chain stability. As markets navigate these dynamics, the interplay between industrial necessity and financial strategy ensures that silver will remain a critical asset in global economic, technological, and geopolitical considerations, serving simultaneously as a hedge, a resource, and a leading indicator of structural stress across multiple dimensions of the modern economy. The ongoing alignment of industrial demand with strategic accumulation establishes silver as a uniquely pivotal element in global markets. Its dual function, both as a key input for technology and as a hedge against currency and geopolitical risks, ensures that traditional assumptions about commodity elasticity and market stability no longer apply. Supply constraints, coupled with non-discretionary consumption and strategic hoarding, create a self-reinforcing cycle of volatility, cost pressures, and systemic risk. Policymakers, industrial actors, and financial institutions must account for this interplay when designing strategies for reserve management, supply chain resilience, and capital allocation. Silver has become a tangible barometer of both industrial vitality and systemic financial stress, reflecting a structural transformation in global commodity and reserve dynamics that will shape markets for years to come. In this context, the current surge in silver prices is a clear indicator of underlying systemic shifts rather than a transient speculative phenomenon. The combination of constrained supply, industrial indispensability, and strategic accumulatio by sovereign and institutional actors has established a market regime characterized by acute sensitivity to incremental demand and elevated volatility. The metal now embodies the intersection of industrial, financial, and geopolitical imperatives, making it an essential instrument for understanding and navigating systemic risk, global supply chain stability, and the emerging multipolar financial landscape. This structural evolution reinforces the centrality of silver in modern reserve strategy, industrial planning, and macroeconomic analysis, cementing its role as both a critical input and a strategic asset of profound global consequence. The current surge in silver demand is not merely a transient market phenomenon, but represents a structural reconfiguration of global financial risk, liquidity dynamics, and cross-asset correlations. The extraordinary inflows into silver by central banks, sovereign wealth funds, and large institutional investors have transformed a previously modestly traded commodity into a focal point of systemic concern, with implications that ripple through financial markets, industrial sectors, and the broader global economy. Traditionally, silver's role in financial portfolios was peripheral, serving primarily as a hedge against inflation or a speculative commodity. However, the convergence of strategic accumulation, industrial necessity, and macroeconomic uncertainty has elevated silver to a status where it functions simultaneously as a tangible store of value, a defensive asset against currency devaluation, and a real-time barometer of systemic fragility. The scale and concentration of these inflows are unprecedented. Central banks and sovereign funds are acquiring silver not in marginal quantities, but in volumes sufficient to meaningfully remove physical metal from accessible market inventories. Unlike speculative retail purchases, which tend to be reversible and highly liquid, these institutional acquisitions often involve physical delivery and long-term holding. This permanent removal of supply from the market introduces structural scarcity, straining traditional mechanisms of price discovery and liquidity provision. Exchange-traded funds backed by physical silver, for example, face operational challenges as their ability to source and allocate metal becomes constrained. Similarly, derivatives and futures contracts encounter settlement and margin pressures when underlying inventories are insufficient to accommodate hedging or speculative positions, leading to elevated operational stress across trading venues. Liquidity constraints are central to understanding the systemic risk introduced by these flows. Silver markets, while global, are far less deep and liquid than those for gold, major equities, or sovereign bonds. When institutional investors channel significant capital into silver, even small additional inflows can produce outsized price reactions. The physical market is particularly sensitive to these shifts because available inventories are thin, mining output is constrained, and incremental supply cannot be ramped up rapidly due to geological, environmental, and logistical limitations. This means that price discovery becomes fragile, and small disruptions, whether from delayed shipments, geopolitical restrictions, or sudden spikes in demand, can trigger rapid and significant volatility. The resulting environment is one in which traditional assumptions about market depth, responsiveness, and hedging efficiency no longer hold. Cross-asset correlations are breaking down under these pressures, creating secondary systemic effects. Historically, commodities such as silver moved within predictable ranges relative to equities, bonds, and currencies, allowing portfolio managers and risk officers to model exposure and implement hedging strategies with a reasonable degree of confidence. The surge in silver accumulation disrupts these relationships. As capital reallocates from equities, fixed income, and fiat currencies into tangible assets like silver, correlations become unstable, producing unexpected swings across asset classes. Investors attempting to hedge equity or bond positions against commodity exposure face heightened margin requirements and inefficiencies, amplifying both perceived and actual risk. This breakdown of conventional correlations complicates capital allocation strategies, forcing fund managers, banks, and corporate treasurers to reconsider risk models that have long guided financial planning and portfolio management. Industrial participants also experience tangible stress as a result of concentrated silver inflows. Silver is a critical input for high technology applications, renewable energy infrastructure, and medical devices. Price volatility driven by institutional accumulation directly affects the cost structures of manufacturers, potentially compressing margins or triggering shifts in production strategy. For sectors reliant on long-term contracts or predictable input pricing, these market stresses can result in delayed projects, renegotiated supply agreements, and increased capital expenditure to secure alternative materials. The convergence of industrial and financial demand creates feedback loops, where rising prices driven by strategic accumulation further constrain industrial purchasing, amplifying volatility and stress throughout the supply chain. This dual demand pressure transforms silver into a systemic risk vector, simultaneously influencing both financial markets and real economy production processes. Geopolitical considerations further exacerbate these dynamics. Many sovereign actors engaging in silver accumulation are motivated by dedollarization strategies, hedging against potential U.S. monetary leverage, sanctions, or geopolitical coercion. These strategic objectives introduce additional layers of complexity and uncertainty for global markets. Physical inventories may be concentrated within specific jurisdictions or institutions, raising the possibility of market segmentation, export restrictions, or regional supply imbalances. Such concentrations heighten the sensitivity of global markets to localized shocks and complicate the operational logistics of trading and settlement. Financial institutions that rely on assumptions of uniform global liquidity must adjust to these geopolitical constraints, further stressing risk management frameworks and contingency planning. The feedback between perceived safety and systemic fragility is particularly noteworthy. Investors view silver as a defensive asset, providing protection against currency devaluation, inflation, and geopolitical uncertainty. However, the very accumulation of silver that creates a hedge also generates structural market vulnerabilities. As more capital flows into silver, liquidity becomes constrained, volatility increases, and settlement risks grow, thereby introducing potential instability into the broader financial system. In other words, the instrument designed as a risk mitigant simultaneously amplifies systemic risk when inflows exceed market capacity. This paradox underscores the dual role of silver as both a stabilizing and destabilizing force, highlighting its significance as a barometer of market stress, as well as a tool for portfolio protection. Operational considerations extend beyond pricing and liquidity. ETFs, derivative contracts, and futures markets experience heightened margin volatility as institutional holdings concentrate. Clearinghouses face increased settlement risk, particularly if physical delivery is mandated or if counterparties encounter liquidity shortfalls. The knock-on effect is an elevated potential for cascading market disruptions. Banks and financial intermediaries must allocate additional capital to cover margin requirements, adjust risk weightings, and revise contingency protocols. For institutional investors, these operational stresses translate into higher transaction costs, the need for advanced monitoring systems, and ongoing assessment of counterparty solvency and market access. The confluence of these operational, financial, and strategic factors positions silver as a systemic stressor, whose impact reverberates across multiple dimensions of global finance. Furthermore, the surge in silver inflows intersects with broader macroeconomic uncertainties, including inflationary pressures, currency fluctuations, and sovereign debt concerns. Investors and central banks are increasingly using silver to hedge against dollar weakness and potential systemic shocks in fiat currencies. As such, silver's price movements are no longer isolated phenomena but indicators of broader financial and economic trends. Sudden price spikes or market disruptions in silver can signal stress in global liquidity, shifts in reserve allocation, or emerging vulnerabilities in industrial supply chains. Financial institutions, policymakers, and multinational corporations must therefore monitor silver not simply as a commodity but as a proxy for structural risk, informing decisions on capital allocation, hedging strategies, and policy responses. In sum, the rapid accumulation of silver by central banks, sovereign funds, and institutional investors has fundamentally altered the risk landscape. Traditional liquidity assumptions are no longer valid, cross-asset correlations are destabilized, and operational pressures on ETFs, derivatives, and futures markets are acute. Industrial participants face rising input costs and supply uncertainty, while geopolitical considerations amplify concentration risks and market sensitivity. Silver's dual role as both a defensive asset and a systemic stress indicator creates a complex, self-reinforcing environment of heightened vulnerability, where each incremental inflow magnifies risk, volatility, and operational complexity. The metal has evolved from a secondary commodity into a critical barometer of systemic financial fragility, whose movements now have direct implications for global liquidity, industrial production, and cross-border capital flows. As markets continue to navigate this unprecedented environment, the systemic implications of silver accumulation underscore the need for enhanced monitoring, contingency planning, and strategic coordination among investors, financial institutions, and policymakers. The confluence of limited supply, concentrated accumulation, industrial demand, and geopolitical strategy ensures that silver will remain a focal point of market stress and financial analysis for the foreseeable future, providing both a hedge against uncertainty and a lens through which systemic vulnerabilities can be observed and managed.